Prepare to go hungry as shelves remain empty. I'm your host, Steven Van Metre, and thanks for joining me today as farmers are facing the squeeze, which could lead to higher food prices and prolonged food shortages. Let's kick this story off where we head over to the Wall Street Journal, which headlines that farmers feels the squeeze of inflation as higher costs for seeds, fertilizer, weed killers, and labor could push grocery bills this year, researchers say. And supply chain constraints and staffing problems are leading to higher prices for products and supplies across a variety of industries, especially food. As U.S. inflation, as we talked about recently, hit its fastest pace in nearly 4 decades. Food prices surged 7% in January, the sharpest rise since 1981, according to the Labor Department, as meat and egg prices continue to climb at double-digit rates. And even as crop prices remain high, supply costs are expected to outpace the price of agricultural goods in 2022, according to a January report from the Federal Reserve Board. Net income for farmers in Kansas is estimated to fall 65% from a year ago, according to a January study by Kansas State University. And of course, all that means is food prices are headed higher as farmers are forced to raise their prices. But let's keep going because it's going to get worse as growers' biggest expenses this year, including fertilizer and crop chemicals such as glyphosate, are used to kill weeds and other pests, are soaring in price. Glyphosate, Roundup's active ingredient, is up about 250% from what it was 12 months ago, and that is a huge problem. Bayer attributed the recent increases in glyphosate prices to a global shortage caused by weather events, energy restrictions, high demand for transportation, and global supply chain challenges. And seed prices are also up, adding insult to injury, as crop seed and pesticide supplier Corteva said prices it charges farmers for seed rose 10% in its most recent quarter, and its crop protection products were up 6% compared with the prior year to offset inflation. We've demonstrated that we can move prices to cover costs, and even worse, they're going to use it to grow margins, as I've suggested will happen before. And the price of anhydrous ammonia fertilizer is up to now more than 200% from a year ago, an all-time high according to an agricultural research firm. Fertilizer price increases partly stem from elevated natural gas prices, a key ingredient for nitrogen-based fertilizers, as well as severe storms in the U.S. that disrupted production plants earlier this year. Major fertilizer producers, including China, Turkey, Egypt, and Russia, also curbed exports in the second half of 2021, further pushing up global prices. As you can see, what this is all starting to point to is food prices are not only going to stay up in 2022, but they actually might even go higher and could persist into the following year. Let's keep going with the story because the potential for higher farming costs to cut in production of corn and other crops could fuel continued food price inflation, analysts say. Higher corn and soybean prices, for example, raise the cost of animal feed for meat companies, which pass along the increase to consumers. I don't think there's any reprieve for food prices to come down, according to the Farmers Business Network. It's just not a logistics issue or supply chain issue to grocery stores. It's deeper rooted than that. And that gets into this whole inflation story about why we see inflation lead to recessions. In fact, we'll come back to this chart. We've looked at this before, but if you look at 10, and I've circled 10 of the last recessions, I'm counting the one that's going to happen, and you look at 12 going back to 1950, 10 recessions were linked to peaks in inflation or periods of high inflation. And so when you add to the story that food prices are going to stay high, what is that going to do to consumers' budgets? Well, it's going to decrease their discretionary spending, and that is going to lead to a recession, as we've seen. But now, one thing that many people ask me about is why are interest rates still pushing higher if indeed we tend to see that high times of consumer prices lead to lower interest rates? Well, you got to understand the psychology of this and how this all feeds back together. And here we see this headline from Bloomberg that B of A clients are the most underweight on tech stocks since 2006. But that's not the real part of the story. They think they missed the boat because cash is king, according to B of A Global Fund Manager survey shows investors are piling into cash. And look at this, the percent of the net overweight in asset class, look at bonds, minus 72%. So what's happening right now is investors are ditching bonds because they think, and they're led to believe falsely, that higher interest rates actually follow consumer prices. Well, what happens is consumer prices rise and squeeze consumers where they can't afford things, and that destroys the growth part of the growth and inflation story of bonds. Well, what comes next is when inflation starts to roll over and head down, well, that changes the tune for bonds. And And here you can see on this chart here that, again, we come back to these peaks in consumer prices. And sure, you get periods in here where bond yields will back up a little bit and then they head lower. And you can see it here again. Consumer prices rise, yields go down as, again, that growth story ends and the inflation story starts to roll over, and then yields keep going down. And here again, you get back into the great financial crisis we've talked a lot about. And what happens? Consumer prices rise. You see yields kind of double topped here practically, and then they headed lower. And there were times they tried to back up and headed lower. Here you're going to see in 2011, same story. Consumer prices rising, yields falling. We see that in about 2018 as well, as consumer prices just got too high. And that is the story of what's coming, is that yields are likely to fall here, again, because consumer prices are going to stay elevated, and it's going to squeeze out the growth and inflation story and lead to lower yields. Now, if you're looking for an investment strategy that understands this, was designed around these concepts, and hedges that risk in advance, well, be sure to check out Portfolio Shield. There's a link in the corner and in the description below. You'll be glad you did. Let's continue on with the story because it gets worse as Wall Street fears market jolt as inflation pinches low-income Americans. And this is exactly what I've been talking about, is that people cannot afford higher prices. You see here, lowest income quintile has less cash than before pandemic. And you may remember, I think in our story yesterday, our show yesterday, one of the articles said that people were sitting on mountains of cash. And I said, you know what? I don't think that's true. Well, let's keep going because it's not. More Americans are having a harder time making ends meet. Consumer prices surged in January, sending the annual inflation rate to a 4-decade high. Rents are skyrocketing. The government's pandemic financial support has largely dried up, and expanded unemployment benefits ended last year. The child tax credit worth up to $300 per child. Remember, this was an advance payment, so its last monthly payout in December. All of these factors I've talked about are putting consumers in a position where they cannot afford higher prices. Let's keep going because inflation isn't the only problem for consumers. It's also the lowest income quintile of the population now has liquid assets below, keyword, below pre-COVID levels, as prior government Lagarde is fading. And he also says in his lowest paying jobs saw strong wage gains relative to high paying jobs, which will help. But as job openings slow, well, that will fade too. And so now we get into today's story from today's data that it's not just a food story, it's not just an inflation story, but we're also seeing producer prices rise as well. And that is going to continue to squeeze budgets. And it also just falls into the narrative of why we'll see a recession and ultimately lead to lower inflation, lower growth. Because think about what's the best way to cure inflation, right? Have a recession, because that will destroy demand. Anyways, let's keep going as U.S. producer price inflation stays hot, according to Bloomberg, reinforcing the Fed's plan to start raising rates. The producer price index for final demand increased 9.7% from January of last year and 1% from the prior month, the Labor Department data showed on Tuesday. The gains from December was the largest in 8 months, as the median forecast in Bloomberg survey of economists called for a 9.1% year-over-year increase and a 0.5 monthly advance. And these are huge. And you can see that producer price inflation is just way off the charts, is way outside of normal. And we go on because the figures which reflected broad increases, this is key, broad increases across categories may bolster the case for Federal Reserve to be more aggressive on raising interest rates and shrinking its bond holdings in the coming months. Now, as we know, the Fed is set to meet next mid-March. Quantitative easing will have ended just before that meeting, and the rumor is they could go as high as 0.5%, but they most likely will at least do 0.25%. Let's keep going because we go on to the story as transportation bottlenecks, robust demand, and labor constraints experienced through 2021 have carried over into this year and risk keeping price pressures well elevated. The combination of stubborn supply disruptions and elevated energy prices will prevent producer prices from reverting to more normal patterns until later this year. And is there evidence to support that? Absolutely. Here you see producer price index against the West Texas intermediate crude price. And well, lo and behold, look at that relationship. As crude oil prices rise, producer prices rise. And as crude oil prices fall, producer prices fall, all telling you that the biggest input for producers is energy. Of course, we know that in the form of crude oil. But are we able to see where these higher prices are being passed on to consumers, or are producers being squeezed at the margin? Well, we can look at this chart here. We take the CPI and subtract the PPI, and while this doesn't give us any indication that there will be a recession from it, you can see going back into the 1970s, when this chart is below the black line, it tells you that producers are unable to pass those higher costs on, suggesting that they're being what's called squeezed at the margin. So as we started out with a story that we're going to see likely persistent food inflation, and that's going to lead to a recession as we see consumer prices stay elevated, where people just don't have the money to afford higher prices without government support. And with oil still trending higher and driving producers' prices higher, well, that means more foreign imports are coming into the country, more bond buying by foreign institutions, and that will ultimately lead to lower interest rates, as well as when the growth and inflation expectations break lower. Of course, the growth already happening, inflation to come next. Well, the Fed will be in a predicament as it continues to be forced to tighten in the face of higher consumer prices. And with that, I'm Steve Van Metre. Thanks for watching. Bye now. The content of this video provides educational information only. It's not intended to provide investment or advice. This video is not to be construed as recognition or solicitation by selling securities, financial instrument, or participate in any particular trading strategy. This video was prepared by Steven Van Metre, personal capacity. Opinions expressed in this video that do not affect the value of financial advising or Steven Van Metre Financial.